guest today. Okay. The author of the textbook that we've been using in our class, Alan Ellman, is here to speak to you guys about stock options. And it's been a topic that has been requested for the past couple of years. I'm not the biggest expert in options, so I figured what better way than to bring in the legend himself. And we have a chat box. So Alan's peer Barry is going to be responding to questions in the chat. So Barry Bergman. So feel free to post questions and they will answer them. And Alan's also been gracious enough to include stocks that you guys had suggested. And I passed on to him many of the stocks that are in our class portfolio. So without further ado, we'll pass it along to Mr. Ellman. Thank you again for joining us today.
Thank you. Good morning, everybody. I hope you all had your first cup of coffee because I'm going to be giving a lot of information. Hopefully it won't be boring. It shouldn't be, because I'm going to talk to you about how to become a millionaire at a relatively early age. And that's an integral part of the book that you use, Stock Investing for Students. Barry Bergman, as Mr. Goldberg said, is going to be responding to your questions in real time as I'm going through this PowerPoint. So feel free to use those chat box questions during the course of my presentation, but I am reserving time at the end for Q&A as well. So we'll take as much time as you'd like us to respond to your questions. Now, the topic is options, and I know you haven't broached that yet in your college career. So we're going to go through some basics of options. So that's the main thrust of my presentation to you. But because of your situation, being in college, I've been there myself, I'm going to also add a few other elements to the presentation, things that you could do today to ensure substantial wealth when you're entering your retirement years, let's say 40 years from now. Also, things that you can do today to become instant heroes to your parents, to your family, to friends from the older generation, how you could help them enhance their portfolio value. So we're going to add those elements as well to today's presentation. So we're going to start off by just giving you an overview. We mentioned the chat box. We're going to talk about learning how to self-invest and how critical it is for you to start today, not tomorrow, but today. Then we'll get into option basics, which is the topic that Mr. Goldberg asked me to speak about. And that's for the future, because the way I do options, which is a very low risk approach to options, we'll get into that, requires that you have a fairly significant cash reserve, which I'm sure most of all of you do not have at this point in time, but will have in the not too distant future. So, but we're going to go through the basics of options, and then the strategy that I'm known for, which is covered call writing, which is considered really the option strategy that is both low risk and eligible to trade in self-directed IRAs. In other words, our government and the brokerages consider this strategy low risk enough, safe enough, and intuitive enough to retail investors like us to use in our self-directed IRA accounts. And that's important because all of the cash that you're going to generate from using this strategy, should you decide to use it, you can defer taxes, or if you use Roth IRAs, never have to pay taxes on all the cash that you're going to be earning for decades and decades should you implement this strategy. We're going to go through some practical application examples, a few that I've taken from a recent seminar that I did, and you're also going to see, I believe, 8 or 9 stocks that you asked me to evaluate. So we're going to use those as well. And then, as I said, we'll talk a little bit about how you can become a hero today to your family and friends from the older generation. And then we'll summarize, and if there are any questions at the end, I'll be happy to entertain them. Let's start by learning how to self-invest. Now, this class that you're in, and I'm not just saying this because I happen to be doing a presentation for this class, this could be the most important class you ever take in college. Now, the reason I say that is because I've been there and done that. I went through college. My first career, I was a dentist. So I went through 4 years of college, 4 years of dental school at New York University. And I always had a little knack for math. So one of the classes that I took in college was calculus because it was a sure A for me. And so I took calculus, then I took advanced calculus, then I took, you got to be kidding me, calculus, A. And the last time I solved the calculus equation was in college. And I graduated, all those years of education. I didn't know how to invest, nothing, zero. I didn't even really know what a stock was. I heard of it. I heard my parents speaking to their broker, sell IBM, buy General Electric, that kind of stuff. But I really had no clue. If I had a class like this when I was in college, I mean, I'm not complaining about my financial situation, but it would have made such a difference much earlier in my life until I taught myself how to use these strategies. Now, this is the important part. And if you're going to take away one thing, only one thing from my presentation today, pay attention to this. You have an advantage right now over me, over your instructor, over your parents, your aunts and uncles, everybody from the older generation, and that is your age. You have that age advantage, and this is the time to take advantage of it. Today is Tuesday, not Wednesday. And that's because of the power of compounding your money. So when you invest today, by the time you're ready to retire, that dollar that you invested today will have returned the most money of any other dollar that you invest down the road. There's a mathematical rule called the rule of 72. What that says is if you take the interest that you're earning or the returns you're earning on your money and divide it into the number 72, that will tell you how long it will take you to double your money. Now, historically, the stock market returns between 8 and 10% a year. In my book, you might remember that I used the lower end of that range, 8%, which if you divide it into 72, that means every 9 years, you're going to double your money. Now, if we use the average of 8 to 10%, 9, it would mean every 8 years, you would double your money. Now, let's say you don't start investing for 25 years until you're like in your 40s. That means you've missed out on 3 opportunities to double your money if you invested in the stock market. 100,000 doubled is 200,000. 200,000 doubled is 400,000. 400,000 doubled is 800,000. The power of compounding is really the 8th wonder of the world. And the best way for you college students to take advantage of this is to start today. That is the main point, the main gift that I can give to you and that Mr. Goldberg is giving to you by providing this trading lab is to start today. Now, we all know people that will have reasons why they can't do something. Let me give you an analogy. I work out in the gym 5-6 days a week. I started about 21 years ago. And when I started, I was committed to do this. It wasn't like, am I going to go to the gym? It's today's Tuesday, I'm going to the gym. During the course of my years in the gym, you always see people coming and they're there for 2-3 months and then they're gone. You have to make this commitment that you're going to start today. Don't give reasons why you can't do it. Figure out ways that you can do it. It'll make a huge difference in your life. It'll allow you to retire at a relatively young age, financially comfortable, being CEO of your own money. You will be in charge. Now, we're going to talk about stock options today. We can start the learning process of options today. And there are really 2 ways to trade options. Risky, which is most people consider options risky, but not the way I do it, or extremely conservative. I am guilty as charged. That's me. extremely conservative. I'm going to talk to you today about covered call writing, one of the most conservative ways to trade options. If I can give you an analogy, when we trade covered call options, we are on the sell side of options. So my analogy is this: we are the casino, not the player pushing buttons at the slot machine. When we enter a covered call trade, the first thing that happens, we get paid. I will get into that. I'll show you how it works. So the actual application of covered call writing, or the option strategy I'm going to show you, requires cash. And that's why you can't, most of you, probably all of you, can't use it today. But you sure can learn about it. And you sure can hopefully tweak your interest. And it is in the final chapter of the book, Stock Investing for Students. I don't know if you've gotten to that. I don't think you have. Mr. Goldberg told me you don't have any options background as of yet. But it's the last chapter touches upon it. Now, the key chapter in that book for building up capital so that you will have the cash reserve to do this strategy of covered call writing, should you decide to implement it, is chapter 6, the game plan. That talks about how to do this. That's something that you should focus in on like a laser, because that'll tell you exactly step by step how to begin the implementation of your becoming a multimillionaire plan. Now, why should you learn and implement it? Well, the short-term goal is so you can get a good grade on Mr. Goldberg's next exam. That's your short-term reason. But the long-term reason is to become a millionaire, and should be a multimillionaire by the time, 40 years down the road. And I'm not basing that on, some kind of strategy, get rich quick scheme. I'm basing it on totally on historical data, as you'll see when you read chapter 6 of my book. So definitions are pretty boring. I get it, but I have to do a few of them. There's not a lot, a few of them to establish the foundation before we get into a discussion about options. So let's first talk about what is an option. It's kind of a made up thing. It's a contract, like you buy a house, you sign a contract. It's a contract that gives the buyer the right, but not the obligation, to buy or sell 100 shares of stock at a fixed price, which is known as the strike price, and by a specific date, which is known as the expiration date. So the contracts expire on a certain date. So it is the right to execute a future stock transaction. Now, you see 100 shares of stock. So if we buy an option or sell an option, it's based on 100 shares of a stock or an exchange traded fund. All right. So if we were going to sell an option on a stock, we would first have to buy 100 shares of that stock and then sell the call option. We'll get into the specifics of that in just a moment. But this is the reason why I say you need a cash reserve, because for every option you sell, you must first own 100 shares of that stock in order to be covered or protected. So we're going to be talking today about call options. So call options, if you buy a call option, you then have the right, but not the obligation, to buy 100 shares of stock at a fixed price, that's the strike price, by a specific date, the expiration date. So if, for example, a company like Tesla, which is one of the stocks you asked me about, is trading for over $1,100 a share last time I looked. So, that's pretty expensive. But somebody may buy a call option for $10 or $100 for the contract for 100 shares, and or $1,000 rather, and they have the control of that particular stock up until expiration of the contract. So they have the right, but not the obligation, to buy it by the end of the contract. So you're controlling the shares. That's why people will buy call options, because they think the stock price is going to go up and they don't have to invest all that money into buying the actual stocks themselves. But there is a whole lot of risk. So don't be enticed by what I just said in buying call options, because there's a whole lot of risk and a lot of factors going against you. But if you're the type of investor, and I hope you're not, that it looks to hit a grand slam home run when you're making your stock trades, rather than singles and doubles, which is where I'm at, then you might be interested in buying call options. Now, put option is the opposite of a call option. If you buy a put option, that gives you the right, but not the obligation, to sell 100 shares per contract at a specific price. So people will buy put options to protect their portfolios. Let's say they bought Tesla at 500 and then it doubled in price. Well, people may buy put options, giving them the right to sell it at a certain price to kind of hedge or protect their portfolios. I've also written books and created calculators and videos and such on put selling in a conservative way, but that's way beyond the scope of today's presentation. But I just wanted to give you a definition of that. Now, this screenshot is going to be a little bit complicated. I'm not going to focus in on it too much. I just want to show you that there are different types of options to sell. The out of the money option, the example is you buy a stock for 30 and agree to sell it for 30. So that 30 strike or option strike is at the money. Now, if there's a very tiny difference, pennies, between the price of the stock and the price we're agreeing to sell it for, that would be near the money. So stock trading at $29.95, the strike is 30, we buy it at $29.95, agree to sell it for 30, that's near the money. Now, the kind that we're going to be using today is out of the money, which is the most popular of all the option strike prices when we sell call options. And that is an example where the price of the stock is 28 and we agree to sell it for 30. Why is that so popular? Think about this now. If we sell that call option, maybe we're going to get a premium of $100 per contract in our cash account as soon as we click the button on our computer. Now we are obligated to sell that stock at 30 at any time over that contract period. So $100 is ours to keep no matter what. But we can also make another $200, can't we? Price of the stock is 28. And if it goes up to 30, we made another $2 per share, or 200 for the 200 share, for the 100 shares. So that's a total of $300 profit. Usually we're talking about monthly contracts. You could do that every month. So you could start to see how much cash we could generate hitting these singles and doubles. Now, the in the money strike, which is very rarely used, but a big part of the way I teach options, is where we agree to sell our shares at a lower price than they're currently trading for. I'm not going to get into too much depth on this. It's beyond the scope of today's presentation. Suffice it to say that in very volatile markets, in very deeply bear markets like March of 2020, when COVID first hit us, those would be appropriate times to use the in the money strike. But again, we're going to be using out of the money for today's presentation. Let me give you an analogy as to how covered call writing works. And we're going to bring Mr. Goldberg back into the picture here, since he's the star of the show today. Let's say Mr. Goldberg owns a home that's worth $150,000. Now, he really likes this house, but he would be willing to sell it if someone offered him $200,000. Now, here I come. I take a look at his house. I like it too. Plus, I find out that Samsung is going to be opening up a corporate headquarters in the area, that other technology companies are going. There's a couple of areas where there's going to be a lot of growth potential because various condominiums are being built. And I think that property can be worth another 100 grand easily within a year. I really like to get my hands on this property, but I'm not so sure that I want to risk $200,000 today. But I sure would like the right to control that property over a certain time period. So now we have two people. We have Mr. Goldberg, who's willing to sell his house for $200,000, and me, who's willing to, I think I want to buy the house for $200,000, but I want to be sure before I make that commitment. So I'm willing to pay him for the right to buy that house for $200,000 anytime over the next 6 months. I'm just creating a hypothetical here. Now, I believe that property is going to go up way more than $50,000 in 6 months. That's my belief. I did the demographics. Hey, look, there's a Burger King and a McDonald's that's going to be opening up pretty soon. They did the demographics. They like the area too. Okay, so Mr. Goldberg says to me, Dr. Ellman, I'm going to sell you an option to buy my home for $200,000 anytime over the next 6 months. But you're going to have to pay me a premium of $10,000 for that right. If I accept and I purchase that option that he sold, now I have the control over that property to purchase it over the next 6 months for the strike price, the agreed upon sales price of $200,000. Now, if the value at the end of those 6 months is more than $200,000, I'm going to exercise that option and I'm going to buy the house for 200. Let's say the price went to 225. Well, I buy it for 200. I have 25 grand profit on the house, unrealized as it may be, minus the 10 grand I paid for the option. I'm plus 15,000 on a property that I really love and that I think is going to continue to appreciate in value. Now, what happens at the end of the 6 months if the value of I was wrong. The value of the property didn't even come close. It's about 175 now. Well, I'm not going to exercise that option and buy it for 200 if it's only worth 175. And so the option expires worthless. But Mr. Goldberg keeps the 10 grand that I gave him. He keeps and retains that property. And guess what? He could now sell another option on that very same property. And that brings us right into the realm of what is covered call writing. Let me break down the 3 words in the term covered call writing. Covered means we buy the stock first. That would be, in the analogy, Mr. Goldberg's house. That's purchased prior to selling the option. And for stocks, it's 100 shares per contract. So we have to buy 100 shares of stock, and then we could sell the call option. The call is the type of option we're selling. We are selling some unknown person because we don't have to call up somebody. Hey, Bill, you want to buy my option? No, we don't have to do that. It's like buying a book or selling something on eBay or Amazon, buying a book on Amazon, type, boom, sell the option. Now, the Options Clearing Corporation will match up buyers and sellers. We don't have to worry about that. So we sell the option. We're selling some unknown person the right, but not the obligation, to buy our shares from us at a price that we determine by a date that we determine. That's the expiration date. The price is called the strike price. Now, writing means we are initiating the trade. We're starting it. We're initiating a sell to open trade when we do covered call writing. We are selling the option. Mr. Goldberg sells the option to Dr. Ellman. That's how it works, but it's all done online. We don't have to use brokers anymore. There's no reason to. The OCC, Options Clearing Corporation, will match up buyers and sellers. Here's a preview example for covered call writing. We buy 100 shares of stock at $48. So our investment is $4,800. Now we are covered. Now we sell the call option. We're selling some unknown person the right, but not the obligation, to buy our shares from us in this hypothetical for the $50 strike price, out of the money, higher than current market value. And we're going to make this a monthly option. So at any time over the next 1 month. Let me throw this in for a second. Option contracts expire on the 3rd Friday of the month, 4 p.m. Eastern time. So option contract monthly periods are not the same as calendar monthly periods. So they'll expire the 3rd Friday of the month, 4 p.m. Eastern time. Now we're going to get paid a premium for undertaking this contract obligation. A typical premium would be $1.50 or $150 for the 100 shares. So $150 initial profit on a $4,800 investment represents a 3.1% 1 month return. We could do that every month. It annualizes out to 37%. That doesn't mean that's what we're going to end up with. What that means is that's our starting point. Now take a look at this, folks. We buy a stock at 48 and sell the option for $1.50. What's our break even? 46.50. If our next door neighbor bought the stock at 48 and didn't sell the option, what's their break even? 48. And this is the reason why if you use this strategy, you should beat the market every single year. And the reason is that you're lowering your cost basis. Now, back to the hypothetical. Let's assume for a moment the price of the stock, which we bought at 48, never supersedes the $50 agreed upon sales price. Stays at 48, goes to 49.99, goes to 46, whatever. The option will not be exercised, and the option will expire worthless, just like if I didn't buy Mr. Goldberg's home. And we keep the $150. We still retain the shares. We had a 3.1% 1 month return realized. Now, what if the price of the stock goes higher than 50? Now, before I go into this one, let me just say, there are ways of avoiding your stock shares from being sold. If you don't want them sold, you can simply buy back the option. But we're not going to get into that in today's presentation. Let's assume it goes up above 50 and we take no action. Well, our shares will be sold at 50. Even if it goes to 55, our shares will be sold at 50. That is our contract obligation. Where are we? Plus 150 on the sale of the option, plus 200 on the sale of the stock, 48 to 50 times 100. Total is $350. That represents a 7.3% 1 month return, and annualized out to that ridiculous number of 87%. Now, you're not going to get this kind of return on every trade in your portfolio every month of the year. You already knew that, but I'm just showing you some of the potential, and you're going to see that in real life with the examples I'm going to be bringing to you in just a second. Here are the skill sets you need for covered call writing. What stock am I going to select or exchange traded fund? What option am I going to select? In the money, at the money, out of the money. And then how to manage your positions after you enter your trades. Don't enter a trade and something goes wrong and say, uh-oh, what do I do now? Better call Alan. Don't do that. Learn, master these 3 required skills if you decide to implement this strategy, and you'll know exactly what to do and how to do it in a non-emotional manner. So let me just briefly give you the pros and cons of covered call writing. You could craft this strategy to use in every market condition. In the money strikes, defensive. Out of the money strikes, more bullish. You could teach your children, in your case, help your parents. They may have shares of stocks laying around, no idea that they could sell call options and generate cash flow every single month by selling covered calls on these stocks. That's one of the ways you could become a hero today. Now, you could control through exit strategies, a big part of what I teach. And remember, it lowers your cost basis, and that's why you could beat the market every single year. Also, if you sell covered calls and you own the shares, you, not the option buyer, capture the corporate dividend. So that's another advantage to covered call writing. And as I said earlier, you could use it in self-directed IRAs because it's considered low risk and intuitive for retail investors. Now, there's no such thing as a panacea. Every strategy will have its disadvantages. The main disadvantage of covered call writing is the second bullet point. Your profit potential is limited to the strike price. So in the preview example I gave, we bought a stock at 48 and we sold the 50 call. If the price of the stock goes to the moon after you sold that option, you can't participate in any share appreciation above 50. So that's the main disadvantage. But as I wrote here, don't get greedy, because if you could make 7% in a month, I mean, that's no reason to break out the Kleenex. The first bullet point, I think, is pretty self-explanatory. If the price of the stock drops below your break even, you could start to lose money. In the case of the preview example, if you bought the stock at 48 and sold the 50 call for $1.50, your break even is 46.50. So if the price goes below that, that's when you start to lose money. Now, as far as the last 2 bullet points, I just put them in there to be thorough. It's not really super disadvantages, but early exercise is possible. You may not want your shares sold. This applies to people that own shares at a very low cost basis, and if they sell them in a non-sheltered account, could create some tax issues. But there are ways of mitigating that, and I also teach strategies to avoid early exercise of the options. And finally, there's a learning curve and a time commitment. You guys are here today, so you're committed, and you're taking Mr. Goldberg's class. So there is a certain degree of commitment that you've already shown to learn how to self-invest in the stock market. And good for you for that. You're off to a great start, guys. Now, let me give you some practical application examples, because the way I'm going to show you how to do covered call writing is traditional, really the way I do it. But there are so many ways to do covered call writing. In addition to that, here are a few of them. And once again, become a hero today with your parents. Portfolio overwriting, just using shares of stock that have been laying around in your portfolio for years and years and years. And you never realize that you can actually integrate this strategy to create a cash flow that you never had before. It doesn't take that long to do. It'll take a few months to learn how to master the strategy. But once you've mastered it, boom, you're off to the races for years and decades. So you may want to breach this with your folks to see if they do have stocks laying around, and you can make them aware of that. And, you know, it may pique their interest. You never know. Now, you sent me a bunch of stocks, and most of them, I believe, were technology stocks. And you guys know the price of these technology stocks. And, you know, you have to like refinance a home to buy these shares sometimes. So I have a strategy I teach where you could use covered call writing to have a large cap technology presence in your portfolio using an exchange traded fund called QQQ. I'll talk about that a little bit later on, but it's a way of having a technology presence, something you may be very interested in, because that's an exchange traded fund I've used the most over the last 2+ decades of trading options. Also, there are ways if you have limited cash and still be broadly diversified. So there are a lot of ways of implementing covered call writing. You're going to see traditional. So what do? We pick a stock. I'm going to show you a few I've taken from a recent seminar I did, and then I'm going to show you the ones that you sent to me. How do I analyze them? They have to be fundamentally sound, you know, earnings and sales growth, technically sound, looking at a price chart. Most of you probably, I don't know if Mr. Goldberg taught that yet, but it's something you should know how to do. It's really, really easy. If you could tell if a line is going up or down or above or below zero, boom, you're a master at technical analysis. You should know how to read a price chart. And then other common sense principles like minimum trading value. What options are we going to use? We could use at the money or out of the money if we're bullish. We could use in the money strikes if we're concerned and want a more defensive position. And then the third skill is position management. Now, I took, in this seminar I did about a year ago, I believe, or 8 months ago, I took a few stocks from a report that we provide to our premium members. And you can see on the left side in the brown cells, I highlighted EDU, AZPN, and CASH. Those are the ticker symbols. The names are in the column to the right of those, not important. So this is an option chain. Let me show you an option chain here. Get this out. So you have the column over here for the strike prices. Remember, you could do in the money, at the money, out of the money. So cash was trading at 38.20. We're going to look at the out of the money, 40 strike, higher than current market value. Now you see two columns here, bid and ask. You notice the bid is lower amount and the ask is a higher amount. So we always sell at the bid, lower. We buy at the ask, the higher. So if we're looking at the $40 strike price, we look at the bid is $1.05. That's what we would sell the option for. Now, there are ways we can negotiate with these market maker guys, and I teach how to do that. But for right now, we're just going to use the worst case scenario, the bid price. Now, you see the ask is 125. So what happens to that other 20 cents, 105 to 125? Well, that's put right into the pockets of the gazillionaire market makers so they could build another level on their yachts. So But when you look at an option chain, and that's what this is, it's a price list of option prices for cash. And we're going to sell it at 105. AZPN, we can go through this relatively quickly. On the top, you see 140.23. The out of the money 140 strike at a bid price of 370. We're going to put this into a spreadsheet in just a second. Here's EDU trading at 136.84. We're going to look at the out of the money 140 strike at a bid price of $5.10. So here's a spreadsheet that I created. Some people call it the Elman calculator, the BCI calculator for covered call writing. These are 5-week returns. On the left side in the brown cells is all the information we just gleaned from the option chain. Let's focus in on just one of these, cash. It was trading at 38.20, right? The 40 out of the money strike generated $1.05. They all expired at the same time, 221. Now, once you fill in those blue cells, the white cells become populated. You don't see brown and yellow. I just did that to make it easier for you guys to see what I'm talking about here. So the return on our option, or ROO, in the brown cells tells you a 5-week return. In the case of cash, it would be $1.05 divided by 38.20. So our initial time value return is 2.7%. Since this is a 5-week return, if we wanted to annualize it out, it would annualize out to 27%. Pretty good, considering when 1-year CDs give like 0.05%. Now, we still have an opportunity, since it was an out of the money strike, to generate additional cash if the price of the stock goes up from the 38.20 price up to the 40 strike, and another 4.7%. The spreadsheet will give you all this data. You just have to fill in the blue cells. So 7.4% max return on that cash CASH trade, 74% annualized. So this just gives you, I'm not telling you that you're going to get these kind of returns. I'm telling you this is how your portfolio is set up initially. This is the initial trade structuring, and this is based on a stock that you screen from a fundamental, technical, and common sense perspectives. And you can see all the other numbers are pretty similar. Okay, here are your stocks. Now, what I did was I just looked up out of the money strikes. So let me just show you here. Okay, these are the stocks that you gave me. Here was recent price of the stocks. And then I went to out of the money strikes. So for AMD, for example, was trading at 157.78 when I put it into this spreadsheet. And the 162.50 strike out of the money, expiring on 12/31. So it's about a month away, generated a premium of $7.62. So you put that into the spreadsheet, and then what do you get? You get the return on your option. Now, in the case of AMD, that was 4.8%. So you want to annualize that out, just multiply it by 12. What is that, 55, 56%, something like that. And you have additional upside potential of 3%. So if AMD goes from 157.78 up to the 162.50 strike, now you've made not 4.8%, but 7.8% in 1 month. The numbers can be eye-popping. But here's the part that I want you to be a little careful about, because most retail investors, they get enticed by high option premium. I don't want you to do that. I want you to understand this. The stocks that have the greatest premium returns, and you could see from the red arrows, I highlighted Tesla, GameStop, and Coin. I highlighted those three. Look at the initial return on option on those three: 7.7, 10.2, and 5.7. Remember, multiply by 12 to get an idea of the annualized returns. So those were the three highest. Now, why are they higher than the others? The reason is that they have a higher, what's known as implied volatility. That means they tend to go spike higher and spike lower than the other stocks. That's what implied volatility means. It's the anticipated price movement of that stock based on option pricing in the marketplace. So if you look up implied volatility, it will give you the IV of each particular stock, and it's usually based on annualized returns and one standard deviation. So it will give you an idea, but when you're selling options, here's what I do. I say to myself, based on my personal risk tolerance, and I sell mainly monthlies, how much of a return am I looking to target? Because a return too low won't make me happy, and a return too high creates risk to the downside, like it does with Tesla, GameStop, and Coin, right? It's risk to the downside. So the good news is you get these huge option premiums, but the bad news is you're subjecting yourself to additional risk. Now, my goal, and this doesn't mean you have to use this or anybody has to use it, but I put this in all my books. This is what I've been using for more than 2 decades now, 2 to 4% a month. That's my initial time value return goal for my securities. So based on these stocks that you sent to me, I would not use, doesn't mean I wouldn't buy them, but I would not use for covered call writing Tesla, GameStop, Coin, would not use them. Stocks I'd be more likely to use based on your list for covered call writing would be Microsoft, Lowe's, Qualcomm, maybe Melly, maybe AMD. But for sure, Microsoft, and by the way, I am, as we speak, in covered call positions with Microsoft, and Lowe's good is another good one. AMD is pretty good also. But look, you could see here, my point to you is this. The high volatility stocks will send you juicy premiums, but in return, you have to be willing to undertake greater risk. Covered call writing is a low risk strategy. I do not believe most retail investors should be changing a low risk strategy into a high risk strategy. Now, I want to talk to you for a second about probably my favorite exchange traded fund, which is QQQ Invesco Trust. Trades on the NASDAQ exchange under the ticker QQQ. And it consists of 100 of the largest non-financial companies that are listed on the NASDAQ exchange. Here's a screenshot taken from like a couple of days ago of the top 10 stocks in the Qs. Apple is 11% of the each share you own, Microsoft 10%, Amazon almost 8%, and so on. Now, if you're looking for technology presence in your portfolio, and you can dollar cost average into the Qs over the years, had you done that 10 years ago, my God, the amount of money you would have had is unbelievable. And you can also sell covered calls on it in addition to that. But this is a great way to have a technology presence in your portfolio. You could pass this on to your families and friends without having to refinance your home to buy these shares individually. So for every 1 share of the Qs that you purchase, you own 100 shares of basically large cap technology companies. One of the most popular ETFs in existence. Recipe for success, education. That's what you're doing now. That's what you're doing in Mr. Goldberg's class, and good for you for that. Paper trade, practice, and then have a long-term plan to outpace the market. Did I mention you should start today? If I didn't, you should start today. Now, let me just show you something to become an instant hero. I sound a little sarcastic, but I'm almost not. Most of your families, friends of families, have financial advisors that recommend actively managed mutual funds. That's what they're probably in. 98% of the time, that's what they're probably in. Actively managed mutual funds. Now, John Bogle, from the founder of Vanguard, wrote a book, Common Sense on Mutual Funds, one of the first investment books I read. And he talks about indexing. And in other words, passively managed mutual funds based on an index. not some big shot deciding, oh, let's put this stock in our fund, let's put that stock in our fund. No, it's just based on an index like the S&P 500 or the Russell 2000 or the total stock market, something like that. And so you don't need some big shot making selections. All you need is a computer, and they'll pick the stocks usually based on the market capitalization of that particular stock. So, you take the price of the stock times the number of outstanding shares. There's your market cap. The bigger ones have more of a presence, like Apple does in the Qs, and the smaller market caps have less of a presence. That's how it's done. So anyway, here's a little experiment I did several years back. Kiplinger magazine puts out the beginning of every year their picks for the top 25 mutual funds to buy. This year it was for the year 2019. So this came out like in December of 18, right? 25, their team of geniuses decided that these were the 25 mutual funds that you should select, and they're actively managed funds for the year 2019. So what I did was I printed it out. Now, at the end of the year, I created comparison charts of these mutual funds to the one you see on the bottom, VFIAX, which is Vanguard's S&P 500 index fund, passively managed. All the others are actively managed. What results did we get? Well, the Kiplinger 25 averaged for the 1 year a loss of 1.3%. That's the stuff that's in your parents' portfolio today. The index fund returned 3%. So it had an advantage of 4.3% over what this well-regarded financial magazine projected to be 25 of the best mutual funds to select for the year 2019. Now, I did this just the other day. I made a comparison chart of the top 5 on the list. One of them was gone. It's no longer there. I couldn't find it anyway. So I did the top 5 that were in existence from that list and I made a comparison chart today. The red arrow on the top right is the VFIAX, the Vanguard Index Fund of the S&P 500. All the others are the other 5, still underperforming the overall market today. They came out to the figures you see on the bottom. VFIAX in the last year returned 29%. The average of the other 5 funds, 21%. That's a big deal. That's 8% in 1 year. You want to be a hero? Ask your parents for the ticker symbols of all the mutual funds that are in their portfolio. They don't have to tell you how many shares they own, just the ticker symbols. Or you could look them up, Morningstar.com. You could look them up if they only know the names, but the ticker symbols should be in there. And then do a comparison chart. Do a 1 year price comparison chart. Let me tell you what you're going to find. If, let's say, they give you 20 mutual funds, 14 to 16 of them are going to look like this chart you're looking at right now, underneath the index fund. 1 or 2 are going to be right at the same level, and maybe 1 or 2 slightly higher. That's what you're going to find. So they're paying some guy 1 to 1.5 points to underperform the market. Does that make sense? In any case, you may be inclined to do that, or you may not be, but I'm telling you, I've done this a few times for people in my family, and I became an instant hero. Because even recently, my wife's brother called me and said, I can't believe how much better I'm doing with index funds. And he's also buying the Qs, dollar cost averaging into the Qs, something you should consider. And his portfolio just exploded. Now, I'm not going to get into frequently asked questions because I don't know, maybe you guys have some. So I'll go to this slide here. And Mr. Goldberg, do you know if any of your students have any questions for me?
Hey, all, does anyone have any questions for Dr. Ellman and Mr. Bergman here?
I have a question. Can you hear me?
Yes.
Can you show us how to actually place these calls, like on like a trading software?
I don't know if I can get into my brokerage account right now. But I could do my best to verbally explain it to you. Let me just see here. I hope I don't lose you guys. I'm afraid I might lose you if I go into if I go out of Zoom. So let me do my best. It's a good question. Let me do my best to just explain it verbally to you, and then if I can come back and do another presentation if you'd like at another date to kind of show you how to do it from my actual brokerage account. Just do a slideshow. Okay, so when you go into your brokerage account and you're going to sell a covered call, the first thing you're going to do is buy a stock. There is a way of doing it is a combination trade where you both buy the stock and sell the option simultaneously. I don't recommend that initially. So you go in and it'll say is stock or option. You click stock, and then there'll be a scroll down, buy stock, and then you be asked the stock ticker symbol, AAPL, number of shares, 100. And then it'll ask you if you want to do a limit order or a market order. A limit order means you're going to give them a specific price or better. And a market order means they'll find the best price for you. With stocks, I usually use a market order because of the trading volume, and the bid-ask spreads are very small. Now, once you own the stock, then you go back in and click on the options link, and there'll be a drop down. What do you want to do? First, you'll put in ticker symbol for Apple, since you own the shares, and then what will come up will be the option chain for Apple. You click on the expiration date, December 17th, third Friday of December, and then you look at the strike prices. And that will give you the premium bid and the ask, and you put it in as a limit order and day only. And then once that is entered, if you put it in at a price that's the actual bid price, it'll be executed in a second. And it'll tell you that. You go to orders, today's orders, and you'll see it was executed. So covered call writing, 2 steps. Buy the stock, click on stocks. What do you want to do? Buy, how many shares? 100, ticker symbol AAPL, whatever it is. Market order, it'll ask you to review the trade, and then you execute the trade. Then you go into orders executed, and you'll see it's there in a second. Then you go into options. What do you want to do? Apple, sell call option, day order only, and then you put a limit order in. And I teach how to put it in between the bid and the ask when the spread is more than 10 cents. But for right now, just picture putting in the bid price. And that's how you do it. I'm sorry I couldn't show it to you. I just was worried that I might lose you on this Zoom call. Any other questions?
Yeah, Alan, I also put a comment in the chat box, just describing the order flow of how the order goes from the customer through the broker to the market maker to the clearinghouse and back again.
Okay, great.
Any
Okay.
other questions? Anyone? Anyone else besides Sean? Dr. Ellman, so I see. So obviously covered call writing is your main strategy. Do you ever use any software or tools that track institutional order flow that you might try to piggyback, whether it's via your covered call strategy or as a different strategy to complement what you're doing, your core strategy on the side?
No, I don't use order flow. I will tell you this, that when there's a spike in volume, there's usually, and I'm glad you asked me this question. when there's a spike in volume, what usually is the reason for that is usually centered around earnings time. Unless some kind of news is expected, like FDA approval or disapproval of a drug, something like that, some kind of anticipated event. But 99% of the time, it's centered around earnings reports. And earnings reports is something that should always be avoided when you're selling options. So as long as there's adequate liquidity for the stock itself, which in what I look for is at least 250,000 shares, average shares per day traded, or for the options itself, where my requirement is 100 contracts of open interest and or a bid-ask spread of 30 cents or less. As long as those liquidity objectives are met, then that stock is good to go, whether the order flow is higher or lower than average.
Thank you. Any other questions from the class?
Well, you know, if your students should think of a question after the presentation is over, they can email me or Barry. You can see the email addresses on the screen there, and I'll be more than happy to get back to you if you think of something later on.
Great, thank you. Let's see. Anybody else, or do you guys have any more follow-up questions on some of the stocks that Dr. Ellman included in the presentation that we own? So what we've been doing, we've been managing a equity portfolio versus the market over the course of the semester with the goal of attempting to beat it. And if we do beat the market over the course of the semester, the students will get some bonus points on their final grade. And it's been in like a collaborative effort where a student will pick a stock and then we'll kind of vote, and we need 2/3 majority of the class to get behind the idea. And since we started, we chose not to add an ETF component to it. So we started pretty much with no exposure. The market's obviously always 100% exposed. So the down days in the tape have helped our cause. So when the new variant hit on Friday, that was a big boost to the portfolio. So I think we actually just kicked positive versus the market for the first time all semester in the past couple of days. So we'll see if we can.
If I was doing well, I know a lot of these. There are a lot of contests that are being run, and you know, yours is different. You're really looking to beat the market, which is, you know, stock pickers can frequently beat the market, but the earnings reports, I don't know if you factor this in at all, but earnings reports have such a huge impact on a portfolio. And what's happened over the years, because when I started trading, earnings reports weren't as big of a deal as they are today, and companies would come out and try to almost exaggerate what their earnings projections were going to be, and then they would get hammered, and then the SEC came in, and, you know, why did you say this? And so now they have to be very careful about litigation, FINRA and the SEC and so on. So what's happened as a result is companies have been muting the guidance that they give when they report earnings. So even if they beat consensus, you know, as far as earnings and revenue growth, they may come up with guidance that causes the stock price to go down or up in some cases. My point is this: because of the muting of guidance that's gone on over the last 10 years, a much higher percentage of stocks have had favorable responses to their earnings releases than in the past. Now, if I was doing a contest, which you're not, but if I was doing a contest, I would tend to pick stocks that have historically had favorable responses to earnings, because you could get such a pop after an earnings report. And, you know, like with my options, I never use earnings. I never, ever use earnings. But if I was doing something different, like a contest, then I would probably factor that in much more. And that's where you're going to see a big spike in volume also, right around earnings time.
Sure. Do you ever use leaps to complement your strategy, or pretty much are you just shorter term covered call and that's essentially what you're
Well, I
do?
would never, your students know what leaps are?
No, probably not.
Leaps are options that expire 9 months to 2 years plus out. So very long-term expirations. Now, I never use a leap when I sell a covered call. Never, for a couple of reasons. The first reason is if you annualize your returns with a leap versus a monthly or a weekly option, it's so much smaller than using shorter term options. Just trust me on that one. Also, when you sell a leap, you're really undertaking a very long-term obligation. Like I said, 9 months to 2 years. Now, whatever reason you wanted that stock at that point in time, today in November 30th, 2021, may not exist in August of 2022. By doing shorter term options, you have an opportunity to reassess your bullish assumptions on the underlying security much more frequently. Now, that said, there is a strategy called the poor man's covered call. And just to answer your question, instead of buying a stock, you buy a leaps option and you write shorter term covered calls against that. So it's a way of getting into a covered call trade much cheaper. I probably have the biggest resource anywhere on the poor man's covered call. I'm not specifically recommending that strategy. I don't use it myself, but we have a ton of information. Plus, Barry and I created a calculator for it that contains, I think, 25, 26 equations within that spreadsheet. That's how complicated the strategy is. But no, I don't sell covered call leaps, never.
Thank you. So for people that do partake in that sort of trade, do you find them they're just better off buying the common stock if they're bullish that far out and just being a stock investor if that was the case?
Well, you have to pick your strategy. So right now, your class is they're buying and selling stock, and there's nothing wrong with that. If you get into, I hope I made an impact with my discussion on mutual funds and the benefit to indexing rather than actively managed funds. And then at some point in time in the future, if you're going to get into covered call writing, then you pick your stocks based on elite performance from the three perspectives that I alluded to: fundamental, technical, and common sense. Now you have a watch list of elite performers. Most of them will have options associated with them. A few won't, then you can't do it. But the ones that do, and then you pick your options based on the return you're looking for. In my case, 2 to 4% a month, and the moneyness of the strike, out of the money, more aggressive than in the money, which is defensive. And then you learn how to manage your trades. So it's intimidating at the beginning. I'm sure a lot of what I covered today is very intimidating to somebody that knew nothing about options. And I know that because it was intimidating to me when I started using these strategies and I was teaching myself. I was scared to death to click the computer to make my first option trade. Now I'm typing and smoke is coming out of my computer. I'm typing so fast. So yeah, it's something that for your class right now, open a brokerage account today. You need $1,000. It used to be $1,000. Maybe it's less now. I don't know. Check with a good, solid broker. Open a brokerage account today. Figure out what your annual income is. It's very little now. You're students. Maybe you work in the summer. Maybe you get gifts for Christmas and birthdays and whatever. Figure out what 10% of that is. If it's 3,000, 10% is 300. Divide it by 12 equal increments and buy fractional shares of a broad market index mutual fund, the S&P 500. And then next year, reevaluate what your income, keep doing it. It's in chapter 6 of the book, Stock Investing for Students. You're on the road to becoming a multimillionaire if you do it today, where you could take advantage of the power of compounding, something that you have this fleeting advantage today that you won't have, years down the road.
Great. Any other questions from the class for Dr. Ellman? No? Sean, anything else? I see you're asking a bunch of questions in chat. Anything else that comes to mind?
I guess I'll ask this question. Do like short-term capital gains like apply the same way to options as they would like any other short-term trade?
The question is a tax question, and yeah, Sean, I can tell you're on the ball. Covered selling options, buying options, unless they're more than a year away, it represents short-term capital gains. But remember that I pointed out that covered call writing is one of the few option strategies that our government and every broker that I know of will allow in self-directed IRA accounts. So if you decide on this strategy and you have an opportunity to trade in self-directed IRAs, that's the route you should go. And then capital gains becomes a non-issue. But if you're trading in non-sheltered accounts, then yes, you're looking at short-term capital gains and losses. Yes.
Thank you.
Anyone else?
Well, your students can always reach me and Barry by email if they think of something after this class.
Great. So everyone take note of those email addresses. Will you be able to send us this presentation?
Yes.
Great.
You know what I'm going to do, actually? I'm recording it now, so I could send you, I'll put it up on YouTube. How's that?
Oh, perfect. Awesome. That'd be great.
All right.
Yeah. And any final questions from the class? Well, Dr. Ellman and Barry, thank you so much for taking the time to speak with us. We genuinely appreciate it. It's been enjoyable using your book in class, and this complements what we've done because we haven't discussed options so far. So huge thanks for taking the time and incorporating the stock ideas from the class into your presentation. And we can't thank you enough for taking the time to speak to us.
Well, I enjoyed it. Thanks for the invitation, and good luck, everybody, on finals.
Thanks for your time, guys.
Yep. Thank you so much, guys. Take care.
Take care.